Paul, how did you know and predict the Tattooed Chef would collapse so drastically here?
So over longer periods of time, this has happened to work out. Actually, a lot of the stocks in the last year and a half happened to work out very quickly because we were at a very peak of euphoria.
Yes.
Tattooed Chef was a company that had very, very low revenues, had a very, very high market cap, and no profit, was actually losing money. And they were issuing shares like crazy to dilute their investors. To me, that's a recipe for disaster. And it speaks to what happens very commonly at stock market highs. People think we can't lose money. So I looked at Tattooed Chef and I saw all these YouTube celebrities who made it on one stock because they got lucky, talking about how, remember, as a lot of value investors will say, a bull market will make everyone feel like a genius.
They all looked like ones,
right?
I mean, big run-ups, and it's never going to end.
But when I have the 18-year-old caddy at Firestone Country Club telling me I'm wrong about Tattooed Chef and Palantir and Bitcoin, I'm like, wait, how is it possible this person is an expert in investing?
Yeah.
The person's 18. So when I looked at with Tattooed Chef, and let's pull up here on our stock on our 8-pillar software, I looked at a company that was hyped like crazy. Look at this. I mean, look at this chart. Boom, 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 boom. I mean, it's just hyped like crazy. It hit a peak of $28 a share. It is now at $10 per share. $10 per share, guys. This is a fall of 60% almost. I look at this saying, wait a second. Actually, it is 60%. I look at this saying, okay, but what's behind the company?
Well, the fans of this would say now that it's fallen, it's even as usual, it's a better time to buy.
And they might be right.
You're right.
In our past videos, if you go look, we were criticized for saying, hey, I don't know where I'm going to buy Tattooed Chef at, but it's probably south of $5. It's not going to hit $5.
It was 9 yesterday.
I mean, it was at 9 something yesterday. It's not far off when you fall from 28 to 9. This is even one of the worst ones. But I just look at it and say, what would I pay for this business? Would I pay $838 million for a business
Good question.
that does $200 million a year? Actually, I might. Now it's getting to the point where it's like, okay, but when it was at, $2.5 billion, okay.
With less revenue.
With less revenue, I look at going, is there growth here? Absolutely. Is there growth? Absolutely. But they're still going to lose money. Because in the growth mode, they got to lose money. And there's two ways to fund your losses: debt or more shareholders through equity. So you'd have to issue a lot of shares, diluting you as an owner. Look at this dilution. Let's go to the income statement right now. Let's look at the quarterly dilution. Guys, only in 2019, they had 65 million shares outstanding. Now they have 82 million, and that was at the end of the last year. 82 million. That is major dilution, almost 30% dilution, which means you as an investor, if you own it in 2019, you get 30% less of the revenue and profit than you got before. Are those YouTube celebrities talking about that now? No, they don't. In fact, one of them out there says that when they issue shares, it makes the market cap go up, to which I go,
uh-oh. It hasn't for this company either.
So exactly. And I look at it saying, over the long haul, companies will be valued at where their intrinsic value should be. But when there's a lot of hype and euphoria, it causes a problem. They project out these growth levels. And by the way, this company is growing. It is growing very well. But guess what? Look at this. It kind of confuses me here. They actually have lower revenue than they did. That could be because of the season. End of the year, maybe. But I thought end of the year they might have more revenue. They are still significantly better than, 25% better, 30% better revenue than the same quarter last year, 2 years ago. But guys, if it's a growing stock, when I hear people just pay whatever it is, I say, fine, then why not $10 trillion? Oh, Paul, it's ridiculous. Is it? Is it? Why do fundamentals matter when we're talking about projections and how great it's going to be, but fundamentals don't matter on where we are today? Now, does that mean that a company losing money isn't worth anything? Absolutely not. But you have to have a process for that. And that's what we're trying to teach. When you got burned on Tattooed Chef, when you got burned by these other YouTube people, you're probably wondering what the heck happened.
Yeah, because it sounds so wonderful, Paul. They cue it up as just a growing company. They show pictures of it in more stores. It's what could possibly go wrong? And I think what really speaks to me is the concept of monitoring your downside risk. Charlie Munger says, just don't screw up. Everyone else around you will. I've been preaching this a lot in our chat to our community. Is like, just be kind of nice and careful, conservative, as you say. Just don't mess anything up. And the rest of the world might, especially with a company like this.
And when they do, you'll be fine. Because avoiding the big 60, 70% losses is how you're going to kill the market. That's how you're going to kill it. And when I look at how this whole community talks, we start to ask the question of, great, how much?
Yes.
That's the important part of asking and investing. The stories are all wonderful. Stories are all great. I've never heard somebody pitch me an investment and it not be the best thing since sliced bread. But at the end of the day is, how much? Because a Tesla's a wonderful car. How about $1 million? Well, no, of course not. Why?
Yes. You always, we talk about how you go to extremes, but you do love going to extremes, and it gives you a mindset of where we should end up. So is Tattooed Chef is a 50-cent stock or a $500 stock? Both seem ridiculous. So where do we lie in the middle? What is the good price to pay for a company like this? We're going to revisit this. You said
most companies, would I pay $1 for? Yes. Yeah. Would I pay 10 trillion for? No. What that means to me and what Seth was saying is somewhere in the middle, there's the right price. When I learned this, it made value investing going, aha. So I just need to wait for the right price. Now, what is that right price with Tattooed Chef? I don't know, and here's why. They are losing money quarter after quarter after quarter. They made money in one quarter. I don't know how. Actually, a couple times back here, but as they decided to grow, they're going to lose money. Is that a bad thing? Not necessarily. This very channel lost money for 2.5 years while we invested in it to grow. And now it's making a lot of money. Great. I believe in that. You have to believe in investing yourself. We have tons of real estate. Every business we have upstairs, of the 8 or 9 businesses we have, we invest money into them. And when they start, they lose money as we invest money into them to grow. It's absolutely wonderful. But they need to take the market cap and look at the company and say, wait a second. If they use this growth and get there, what are they worth? They're probably selling for higher than what they'd be worth when they hit the goals they actually set, because people extrapolate out profit margins and profit. When people see profit going like this, they automatically assume it's just going to keep going like that. But guys, profit's going to go up and down based on mean reversion and based on people entering the market. You're telling me Tattooed Chef doesn't kill it and all of a sudden people are going to enter? Look at AWS. Amazon Web Services is what Amazon makes a ton of money at. Guess what? Oracle does it now. Microsoft does it now. Google does it now. Everyone does it. Why? High profit margins. And I've said about that too. The margins will get lower as competition comes in. That's what happens.
So the champions of this stock say this is a very long-term play. But
it very well is.
But we want to reiterate the concept. It's not what you're buying, it's what you pay. It's
Correct.
Not what you're getting. It's really what you pay. You can never go back on your initial investment. And some people have lost a ton on this, Paul.
So the analogy I always give is 96% of this channel is men who watch. So they all probably love sports. Michael Jordan, would you pay him $50 million a year today? Well, maybe it's a bad example because everybody thinks he's the best. But let's say Barry Bonds. Would you pay him $100 million a year today? No, probably not. Would you pay him $1? Absolutely. Somewhere in between is a reasonable amount to pay for them.
How do we get there?
And that's what we're trying to teach here on this channel. That's what's been asked of us, and that's what we're giving back to our community of people who believe in what we're doing. And if it speaks to you, great. If it doesn't, I get it. But I do know that the Tattooed Chef and the Palantirs and all these other stocks that have collapsed, it makes sense to me. I don't sit there and go, what the heck happened? I sit there and go, what the heck happened when it skyrockets? I'm like, I don't get it.
Mm-hmm. Okay, Paul, so say I'm absolutely in love with this company. I know something that maybe you or I don't. What am I buying? What is a great price to buy this company at?
So we have the stock analyzer tool. And what this does is every investment's the present value of all future cash flow. Some of that future cash flow could be negative. The stock analyzer tool is best with companies that make money. But I want to show you what I'm looking at with Tattooed Chef. Here's how I look at my investment process. I go to the stock analyzer tool. And I'm going to put in assumptions of revenue growth, profit margin. I'm going to put these assumptions in, assuming it's making money, and show you what I would pay for it if it were making reasonable money today. So revenue growth. I'm going to go 20, 25, and 30% revenue growth. And I'm going to go 5 years, guys, because I don't know what it's going to look like in 10 years. And this is kind of apprehensive for me. Profit margin. I'm going to go 5, 10, and 15, because guess what? They haven't really made money. So I don't know what that number is going to be. PE. I'm going to go 15, 18, and 21. And same with the price of free cash flow. And I'm going to do my 12.5% return because I want some margin of safety in there. I should actually put a higher margin of safety in here because it's a much more volatile company. It's so young, it's more likely to collapse. Analyze. And guess what? If you believe my high numbers, it's a buy today. Guess what though? That assumes they start making money today. That assumes that all the numbers I said in this high category here are correct. And they're going to go 30% a year for the next 5 years. They're going to have 15% margin. They're going to sell for 21 times their profit and free cash flow. And you want a 12.5% return. Is that possible? Absolutely. Is it probable? I don't know. And in the world of investing, the best thing you do is say, when you don't know, you step away. Because if you don't know how it's going to make money, you will have no clue how it will lose money. So your job that we're trying to teach here is to sit there and stay within your sphere of competence and understand what you're buying. If you understand what you're buying, you will understand when it doesn't work, why it didn't work, and when it does work, why it did work.